Welcome to the Disruptive Innovation Festival. We are in week 4 of this 4-week-long open access online event, but don't worry, many of the sessions are recorded and will be available for a bit longer. The following session is part of the Ellen MacArthur Foundation's Rules of the Game stage, exploring the system conditions that influence and govern economic activity and their role in shifting from a linear to a circular economy. My name is Stephanie. I'm leading the Foundation's Regions program, and I'm very pleased to introduce you today to Richard Mattison. Richard is the CEO and one of the founding directors of TruCost. He has led groundbreaking projects, including developing the world's first environmental profit and loss accounting for Puma, valuing the environmental externalities of the world's 3,000 largest companies for the United Nations Principles for Responsible Investment, and producing the UK government's environmental reporting guidelines for business. He has also advised various United Nations bodies and governments on environmental reporting and ecosystem services. He is an advisor to the Global Reporting Initiative and the Economics of Ecosystems and Biodiversity Coalition. He also sits on the Stranded Asset Advisory Council, which we hope to hear more about in a bit. And previously, Richard held a number of senior positions as a strategy consultant and holds a PhD in neuroscience from the University of Edinburgh. TruCost is a global natural capital consulting firm, and with their data and analytic services, they help their corporate and governmental clients to value externalities and identify natural capital dependency. This allows to manage risks associated with volatile commodity prices and increased environmental costs, and ultimately build more resilient business models. Richard is going to present his work and is happy to answer all of your burning questions. So please share them with us either via Google Hangout or via Twitter, and we'll put them through to Richard, who is going to start with giving us a bit of background on TruCost activities. Please, Richard.
Great, thank you, Stephanie. So I'll just, I will start the presentation now. Okay. So thank you very much, Stephanie. It's my pleasure to be here today to talk to you about natural capital, which is really the focus of our work and has been for the past several years. In fact, the past decade we've been working on this. Many people would say there is a standard business mantra that says that what is measured is managed, and I would actually disagree slightly with that. I think there are a lot of things that are measured that aren't necessarily managed. So, to my mind, it's very important that we understand what is valued, because typically what we find is what is valued is managed. So, generally speaking, the issue that we have in terms of sustainable growth, we would envisage this way. Our challenge is from now onwards to improve human well-being whilst growing our economic activity and reducing our environmental impact in absolute terms. This is the growth conundrum, if you like. This is the issue as to how you increase GDP, if that is the right measure, and there's a lot of debate around that, whilst decreasing environmental impact, which we absolutely must do if we're to achieve our climate change targets and avoid continued destruction of ecosystems, and also improve human well-being at the same time. But this is not without its challenges. So if you look at the growth, we're anticipating 3 billion more middle-class consumers by 2030. So every CEO will be seeking to satisfy that demand. However, if I just take one environmental metric, what you can see here is that by 2030, so over the same time horizon as we will see 3 billion more middle-class consumers, there will be demand for water will outstrip supply by 40%. So we have a serious issue because business as usual, and the way in which we use water, for example, will not be sufficient to satisfy that demand. And if you take a closer look at why that might be, well, part of the challenge is that markets are failing to price water correctly. So if you have a look at the price of water in Copenhagen, for example, which is $7.38 in US dollar terms, water is pretty abundant in Denmark, and that's a pretty high price for water. Whereas if you look at the price of water in Jeddah, it's 3 cents. And clearly Jeddah is not a place known for its abundance of water. So essentially what we find if we examine water and water pricing globally, there's a negative correlation between price and scarcity, which means that essentially we're encouraged to use water where it's more scarce, by and large. And it's that failure to price scarcity that is driving unsustainable production. And it's a failure to price ecosystem services and the services that nature provide to us that is driving deforestation and many other forms of degradation that we're witnessing globally, and also pollution. So to cast the problem, this is what it looks like. Essentially, we are creating economic cost to society as a consequence of our actions, but the actors who create these costs, say the companies, are not necessarily paying for them. So when companies emit carbon emissions, they don't suffer the economic consequences of the total economic consequences of that. So they don't pay the full social costs of carbon. Similarly with pollution, companies that create pollution don't pay for that pollution. And these are serious issues. So in the case of pollution, if you examine the impact of air pollution on China, which stacks up in forms of health, the healthcare costs, crop yield is on average between 7 and 15% less in China, and various other factors such as acidification of water. Essentially China's GDP is reduced by between 5 and 10% of GDP per annum, total GDP. So what that means is really that air pollution in China is creating a huge problem for the Chinese economy, and you can measure that in economic terms. And these are called externalities. In that case, that's a negative externality. Similarly, sometimes companies that create products that are beneficial for the environment create positive externalities. So these aren't necessarily income streams for them today, but they are creating positive externalities to society in reduced cost. And we believe it's critically important to understand this, because this is part of understanding society's bottom line. This is part of companies understanding how they can create shared value for society, both for themselves and for society as a whole, as a consequence of their interventions to drive sustainability. In 2011, we conducted a study for the United Nations Environment Programme and also for the Principles for Responsible Investment. And we found that essentially, if you add up the damage created by the world's top 3,000 largest companies, these are the listed companies, that the environmental damage would amount to 2.2 trillion. Now that's approximately a third of the total damage created by businesses globally. And is a huge number. But what does that really equate to in terms of companies? What would happen if they had to pay for their environmental damage? Well, we calculated that if companies had to pay for their environmental damage, it would, on average, and the variation is quite significant between sectors, but on average, they would have to pay around 50% of profit. So really what we're talking about here is, do we need new measures of success? Do we need to really understand how profit can be impacted as a consequence of environmental costs and the potential for those costs to become your costs, your company's costs? Do we need to understand how we can create new measures of economic success, such as GDP? Do we need to have new market mechanisms? Do we need to think about different formats for bond issuances, for example? So we see a lot of emergence in terms of new measures that are emerging right now. There are a lot of green bonds being issued. The World Bank is working on a project to define how to modify national accounting systems such as GDP. And I'm going to go on and talk about the concept of environmental profit and loss. And you also have Unilever, who has, and many other companies, frankly, who have plans to decouple business growth from environmental impact. And you have a whole movement around net positive and circularity. So really, what we're seeing here is there's a lot of appetite to change the way business works in recognition of the fact that business as usual is broken, and we need to pursue new models. And we need to define success in a different way. And really, the way we think about this from an environmental perspective is we need to define natural capital. So what are the services provided by ecosystems? And we also need to define what is the impact on those ecosystems as a consequence of our business activities. In 2012, we helped Puma, along with PwC, create what they called an environmental profit and loss statement. So this is an environmental profit and loss account that sits alongside their normal account, and it quantifies natural capital costs across the company's operations, supply chain, and product portfolios. And so what we did was we looked at Puma, we looked at all the different tiers of its supply chain, we quantified the environmental impacts created, and then we expressed those impacts in financial terms. So the headline figure was that 145 million euros of environmental cost was created by Puma in that year, in that previous accounting year. And largely that was created through raw material production. So what we then did was we helped Puma create a deep dive across the life cycle of products. And in particular, we looked at products against product benchmarks. So they developed a series of cradle-to-cradle certified products, and we looked at those products against the conventional products that we had already analyzed. And the benefit of doing the analysis, this environmental profit and loss statement in the first place, was that it allowed them to create that benchmark against which they could measure success. So those new products they created, an organic biodegradable cotton t-shirt and an organic biodegradable Puma suede shoe, created a 31% reduction in impact against their conventional counterpart products. So that means those products are 31% better for the planet. Move forward to 2014, there's been a lot of work on developing these types of accounting approaches. So for example, we're working as part of a huge collaborative effort amongst many, many different organizations on a natural capital protocol, which sits under the Natural Capital Coalition, which is an organization that has been put together with the collaboration of various bodies such as the IUCN and the World Business Council for Sustainable Development, the World Bank, the IFC, and various other organizations to create protocols that companies in particular can use to analyze the impact of their operations and their supply chains and their value chain as a whole, and to also analyze the benefit of their interventions. We ourselves, TruCost, we've been working for the past few years with many, many organizations, about 40 companies in the last year, on natural capital accounting, and we've done a range of projects from corporate-wide, enterprise-wide projects, down to projects that assess the benefit of specific products with organizations like Interface, for example. And just to go on and talk about some of these, we've worked with TEEB, the project called the Economics of Ecosystems and Biodiversity, on creating a view for Natura in Brazil of comparing single crop production of palm oil with agroforestry techniques to produce palm oil, so monocultural production. And what we found is that this is an interesting way of defining the benefit of different agricultural production. So I urge you to go and read the TEEB for Brazil report, which has more details on how we did this analysis. But here you can see that there's a net benefit, economic benefit, in real terms associated with these different forms of production. We've also done various other pieces of work. This is one, for example, with General Mills. General Mills is a huge food business, and we've analyzed the entire supply chain for General Mills, looking at a range of different areas of natural capital use, which is really allowing them to redefine food production strategies globally and think about the commodities and the products and the raw materials they buy to create their products going forward. And this is redefining the way in which they think about their supply chain. And with Ecolab last week, we launched a tool called the Water Risk Monetizer. So what this does is it analyzes the true cost of water. It places a financial value on water scarcity, so that as a business, when you're thinking about allocating capital to particular projects, you can add in an element of the net present value calculation that might be associated with the future price of or future economic value of water, so that you can enhance your decision making and you can allocate capital in a better way. And the final example I'll just briefly talk through, just conscious of time, is that we also did a study this year with the Cradle to Cradle Institute, looking at the business case for Cradle to Cradle certified product, but really measuring the impact of optimization. What is the benefit of some of these design interventions across various different metrics? So these are the metrics that we looked at for, in particular, this is Shaw EcoWorks, so carpet tile, and we looked at the benefit in terms of toxicity, materials, water, cost savings, sales, and environmental costs overall. So just to pick out a couple of benefits here, we looked at the increased amount, 46% increased amount of recycled materials used, and a 48% reduction in water usage led to a 39% reduction in environmental costs. So that is a straightforward benefit to society as a consequence of these design interventions. But the benefit to EcoWorks also is clear. So they had cost savings of $2.5 million and a 340% increase in sales over the previous 2 years after they launched the carpet tile. So that's quite a significant track record, if you like. So here is an approach that benefits society, and it benefits the company, and it benefits the planet. So ultimately, we would view the future as looking like this. We would view these types of techniques and these measures of benefit, measures of circularity, all those kind of things, we would view them as being appropriate in the following 3 areas: communications, risk management, and the development of new products and new designs for standard product. In terms of communications, we would see that these types of techniques would allow companies to really think about how they are driving benefits through their product interventions, but in particular reporting on those. So for example, as part of the integrated reporting, the IRC framework, companies could report on natural capital being one of the 6 capitals that they need to report on using some of these techniques. And for investors interested in the topic of stranded assets, this is very interesting because investors are becoming increasingly interested in stranded assets. Stranded assets are assets which could be, the value of which could be impaired to a much lower level than expected, or 0 at some point in the future. And we would anticipate that there will be stranded assets as a consequence of things like water scarcity, policy changes, availability of materials. And so being able to understand today and put a price on scarcity will allow a business to mitigate the risk of having stranded assets in the future. And these are especially relevant for long-term investments. Also in terms of risk management, clearly thinking about companies' risks as they accrue along supply chains, so thinking about sourcing decisions, and also assessing natural capital alongside a pure financial business case. And then in terms of product development, I've already talked through how design considerations and the benefit of those design interventions can actually be measured in economic terms, and ultimately that could be the engine that drives a simple form of communication for product labeling. So I'll leave it there, and I look forward to answering your questions.
Thank you, Richard. That was a great introduction to natural capital accounting, and I think some great examples and impressive figures on cost for externalities, taking the China example, and helpful perspective on what that can mean for companies like Puma or EcoWorks. We also have first feedback from the audience. Sylvia, for example, asking you to please make this work, in particular the environmental P&L, better known in the US. So obviously, first fans out here. I would ask you if you could please elaborate a bit more on how this work supports actually the decision making of companies and governments, and how it then translates into economic value for them.
Yeah, sure. So I think when thinking about governments to begin with, I think that governments, this is incredibly relevant for governments, because governments set the framework for economic activities, and without understanding some of the negative economic consequences as a consequence, as an outcome from your policy decisions, it's almost impossible to drive a sustainable economy. So if you're encouraging economic growth, more steel production, more energy production, more manufacturing, but you don't understand the trade-off that is associated with more air pollution, more use of scarce resources, more use of water, and more CO2 emissions, then if you can't compare the economic benefit with the economic loss that's been created, you're not driving a sustainable economy. So if China's GDP is being impacted by 10% per annum as a consequence of air pollution, then that is a measure that should be compared alongside the growth in manufacturing, the growth in energy production, and the growth in raw material processing. Mm-hmm. Because in some cases that externality can not only seriously impact on the growth numbers, it could wipe them out entirely. So if I were to frame that in a different way, solving an air pollution problem may actually cost a significant amount less. It may mean an investment of 0.5% of GDP to create a 9.5% accelerated growth for that economy. So we think that broader economic measures are really required to truly understand the benefit that's associated with policy interventions. For companies, that feeds into how companies should be viewing risk. If they continue to create very, very large environmental costs that society is bearing whilst maximizing their own profit, that model will not last very long. And in fact, we're already seeing pretty quick internalizations of external costs. So for example, if you look at agricultural commodities today, the volatility associated with agricultural commodity prices is 3 times higher than it was in the year 2000. And the reason why is because big spikes in prices are often created by water shortages. And so commodity markets, in a very non-linear way, quickly internalize costs, but they do it on a global average basis. And so companies are already facing increased costs. In fact, Unilever in 2012, Paul Polman said that climate change cost Unilever around 300 million euros in 1 year. So we are already seeing costs impacting the company's bottom line. And therefore, there's an opportunity, I believe, for companies to optimize the way in which they produce, manufacture, and market their products, and also genuinely realize the benefit of their product interventions where they're trying to drive economic outcomes for themselves, but also benefits for society. So if you could say that you're developing a product that requires an investment of 100 million, the environmental benefit is $1 billion to society, and the revenue opportunity is 200 million, it changes the way in which you would view that investment. So that's what we're finding.
Thank you. Good questions here coming in from the audience. James is asking, is there a risk of this standard message about externalities unintentionally reinforcing the linear lock-in by offering a solution where profits fall by 50%? And does the circular economy potentially offer a better message where it's a price of success that you're putting into the focus?
Yeah, I mean, if we're being purely economically rational, we should drive the biggest benefit associated with the most effective form of investment to drive the biggest benefit. So, to my mind, the circular economy thinking is critical to how economies need to be shaping their future policies. And I think, but I do think that you can measure the benefit of those policy interventions, so circular economy type thinking in economic terms, because then policymakers have a very clear message that they could use and a very clear evidence base as to why they need that policy. I think today, if you were in an environment team in government, and you had to go to your finance team or your treasury team to build a business case, if you did that without stacking up the benefit in economic terms, it would be very hard to communicate your case to the treasury colleagues that you have. So, for example, in the UK, let's take a really discrete example. In the UK Department of Environment was seeking funding of a low number of millions, let's say £5 million, to address the issue of pollination and the issue associated with bees and the decline in the population of bees. Now, the argument to the Treasury in the UK was made far more effective by an analysis that showed that pollinators benefit the UK economy to the scale of about at least £500 million per year. So, cost benefit. And that's a very, very clear argument to communicate. And that's what we think is necessary in shaping policy.
Thank you. More questions coming in. Two quite related questions. So Daryl is asking, why do you think governments are not taking measures to actually make companies accountable for those negative externalities, and should they? And Sylvia is asking, when do you think integrated reporting, that is sustainability and financial, will become mandatory for public companies?
I mean, I think governments are beginning. I mean, the whole thrust of environmental policy should be about taking measures to make companies accountable for negative externalities. And in fact, there is track record for this. So in Europe, there's the Clean Air for Europe directive, CAFE directive. And the CAFE directive has quite successfully actually implemented a raft of measures to address air pollution. Now, the genesis of that directive was a study by the World Health Organization that estimated that European GDP was impacted by about 1.9% as a consequence of air pollution. So the cost of air pollution to European citizens is 1.9% of GDP. That was in 2000, I think it was. And since then, there have been a raft of measures that have been introduced. So, for example, in London, there is a congestion zone. There are the clean air, the CAFE directive have impacted on energy efficiency for cars, for example, fuel efficiency, and driving greater fuel efficiency for cars. So all of this reduces air pollution. Catalytic converters help, those kinds of things with the right filters. So there are policy measures that have been quite successful, actually, at driving a reduction in negative externalities. Another one might be the landfill tax in the UK. The landfill tax is a tax that started off at a very low base and is increasing on a ratchet mechanism every year, such that it's at quite a high level now. Now, the way in which that policy was initially formulated was to understand the full negative externality associated with landfill today and the growth of landfill into the future. And so that sets an evidence base for the policymakers to introduce a tax that is imposed on the polluters or the producers. So it's a producer pays tax, effectively, or polluter pays tax, depending on your view. So I think there are examples of where governments have been effective, but they need to be far more widespread. And I think governments could do far more analysis of the costs and benefits associated with various different interventions so that they invest to create the biggest benefit. And I think, again, that's where the circular economy thinking can drive quite significant change.
Thank you. That's a promising initiative. James would like to get your perspective on the following. He's asking, are we missing the big systemic opportunity with externalities? Not just getting into companies' decisions, but into prices and hence all market decisions.
I think there is a big debate around this right now, because actually, if you for example, if all market decisions are informed by externalities, you could actually say that externalities become prices, and when ecosystems are priced, you could argue that we're essentially putting a price on something that is invaluable, that is priceless. So there are some arguments there that say it means you could trade ecosystem services. Now that is already starting to happen, but there are some risks associated with that. So what price are you willing what costs are you willing to sacrifice to trade a rare species and allow that species to go extinct? So perhaps there are no-go areas, untradable parts, and perhaps there are tradable parts. On the flip side, I do think that markets can solve a lot of problems, having created those problems in the first place. An adjustment in a view of market pricing can make a big difference. And in fact, if you look at carbon pricing, 150 companies now have a carbon price. Exxon's carbon price is $80 a ton of CO2 emissions. Now, that is nowhere near the EU emissions trading scheme price or anything resembling a trading scheme price globally. That is closer to the social cost of carbon. But they can use that internally to drive decision making, to drive more efficient capital allocation, to drive a better process by which they think about the future of their business and the investments they're making today. So I do think that shadow pricing can be quite successful to change behavior.
Cool. Ian wants to know, what evidence is there that stock markets are interested in seeing environmental profit and loss accounting?
I think stock markets are interested in seeing the extent to which companies are truly understanding risks and have a good risk management framework, and that they can communicate that they do have a good risk management framework, and that they are acting on that. So it's one thing to say, yeah, I have an EP&L, but the only purpose of an EP&L, to my mind, should be to drive the right outcomes. So clearly, we think that there's a very useful approach that says if you understand the impact your business is creating in economic terms, and you're driving sustainability, if you can measure sustainability in financial terms, financial benefits, then that's a clearer form of communication to stockholders or investors. So the extent to which investors are involved is really to understand where companies have a better risk management framework. And again, this is relevant in the debate that surrounds stranded assets. So are companies making investments today that could be worthless in the future because of scarcity, because of changes in policy? And more importantly, do companies know where they're doing that? And again, an understanding of externalities will help both with that analysis for companies directly and also for their communication to investors.
Great, thank you. Related to that, Daryl is asking, do you think your work on Puma's environmental P&L did actually have some impact on how they are doing their business now?
Yeah, there's a huge amount of work that's going on. So Puma kicked that project off. Puma are part of a group called the Kering Group, and they have taken the work that Puma have done, and they are essentially analyzing, using that approach, to analyze the entire business of all the different companies, including people like Gucci and Yves Saint Laurent and various others. And so we believe that Puma have really created an opportunity out of understanding their impact today. So, for example, if you look across the Kering Group as a whole, they now understand much more fully scarcity across the business. They understand where materials that they're buying and that they rely on are facing some risks in the future, and where that might be geographically, and what they can do to solve that. And I know that Michael Butler is speaking later on today from Kieran Group, and I'm sure he will tell you all about that. But I think that the work they're doing is incredibly impressive and has made a lot of difference within their group.
Thank you. Yeah, actually, I think the session is on Thursday at 5 p.m. UK.
Okay, sorry, I thought it was today. Right, great, fantastic.
Yeah, please tune in, have a look. Fantastic. I mean, all of that sounds very convincing. And the question is, what are the barriers then to implement such kind of measurements and accounting practices at scale? And what needs to change?
Well, okay, so I think actually the first barrier is the first barrier we had before we even thought we could create an environmental profit and loss statement, which is that not enough information is flowing along value chains about impact and opportunities that can be created out of mitigating those impacts. So quite simply, the only thing that flows across a value chain successfully is price. The only thing that businesses really truly know about eventually the product they have is price. Most businesses can't even tell you where their raw materials come from that are fed into a particular product that they are then going to sell to the final customer. So that's an issue. We're not having enough transparency, enough flow of information. And in the world of big data, I have a hope that we can solve some of these problems using big data analytics and tools. Because once you have basic information about not just price, but scale of production, by location, and those types of things, we have all the relevant tools to create the right set of analysis along the value chain, and then to be able to analyze the kind of product interventions that you can make using cost-benefit analysis techniques to drive huge improvements in sustainability. But today we can't do that because there's not enough information flow across the value chain, and I think that is our biggest challenge to scaling. But I think there are some very interesting initiatives going on. Obviously, there is the whole Circular Economy Initiative. There's also initiatives such as the Sustainability Consortium and the Sustainable Apparel Coalition, who are all seeking to drive better information flow across value chains about products. And so I hope that in the very near future that we will be able to be able to use some of these accounting techniques across the value chain to really drive improvements in sustainability.
Thank you. Daryl is saying there are a lot of companies that profit from the current system that companies are not, or only to a limited extent, accountable for their externalities. How can their resistance be overcome?
Well, look, there's a simple fact that the business model that a lot of companies are pursuing is going to be made redundant quite soon, within a decade. So what you don't want to be doing, whilst a lot of companies are making a lot of money out of maximizing externalities and maximizing their profits as a consequence, what you don't want to be is you don't want to be Kodak when smartphones suddenly introduce cameras. And I seriously think that we are facing various tipping points that will create quite radical shifts in how companies operate within their sectors. And there are a huge amount of opportunities for innovation to drive changes that will create bankruptcy in some cases. So I think any company that sits in a business as usual model today is doing so in ignorance of a future of significant scarcity, geopolitical shifts, climate change, and a real race in terms of access to resources. And so companies that are today exploring circular economy thinking such that they have less reliance on primary production, for example, are the businesses that will succeed in the future. So I wouldn't say it's a nice to have. I would say it's pretty critical to the success of a business in the future.
Thank you. Well, we are coming to an end. Please, if you still have any burning questions, put them through now. Thanks a lot, Michael. That was really sorry, Richard. That was really interesting perspectives on the topic, and I think a very clear statement on that businesses need to prepare for the future by taking these externalities into account. And I think TruCost is offering a great portfolio of data and analytics in that area. For the audience, we do have sessions coming up. Janine Beers and Michael Paulin, followed by Rachel Botsman and David Rowan on emerging technologies tomorrow between 5 and 7. And well, any closing words from your side?
I mean, the one thing I would say is just to say that this is something that is really as an approach to understanding businesses better. This is something that is growing very rapidly. So I would urge any company, for example, listening to this, to get engaged with the Natural Capital protocol development, because that protocol will drive standards that sit behind how you conduct these types of assessments. I guess as a final quote, we should learn from our forefathers. So Benjamin Franklin once said, "We'll know the worth of water when the well is dry." And I think, you know, indigenous peoples know full well that they need to you know, really value what is around them so that they have enough for everybody everywhere. So to my mind, we should know the worth of water before the well is dry. And that's why these tools are so applicable.
Thank you.
Thank you.